Welcome back to the channel, and before we go any further, take a second and really look at what's happening in the market right now because most people are sleepwalking through it. This Thanksgiving week has lulled retail into complacency, and that's exactly when major shifts tend to happen. Liquidity dries up, attention drops, and the average person tunes out. But if you've been around long enough, you already know this. The market doesn't wait for holidays, and it definitely doesn't care who's carving a turkey. XRP sitting at $220, hovering flat on the day. Looks boring on the surface, but that's precisely why you shouldn't ignore it. The sentiment feels muted, the hype isn't there, and retail is distracted, which ironically creates some of the best positioning windows you'll ever get. Meanwhile, Bitcoin quietly triggered a buy signal on the 1,348 exponential moving average. Ethereum reclaimed $3,000, and pockets of the market like Caspa running 50% in 2 days prove once again that opportunities don't disappear. People just stop paying attention. If you disconnect for even a week, you miss the moves period. And while most viewers clock out during holiday slowdowns, the smart ones stay plugged in because these dead zones often reveal the next setup before the crowd wakes up. The question you should be asking right now isn't whether the market is exciting, it's whether you're disciplined enough to watch the signals when nobody else is looking. Stick with me because what's coming next in this breakdown will make the current calm look like the quiet before a storm. Let's get straight to it because this part of the story is where most retail investors fall flat on their face without even realizing why. While everyone is busy staring at day-to-day price candles, the real movement is happening underneath the surface, in ETF flows, dominance shifts, and behavior you only notice if you're actually tracking the data instead of waiting for crypto TikTok to spoon-feed you hype. XRP has cooled off after that sharp move earlier in the week, and people assume that means interest died down. Wrong. What actually happened is that the flows rotated, and if you don't understand how these rotations work, you'll miss every major breakout before it happens. Look at the early ETF activity. XRP came out swinging with powerful inflows on its first few days. Then the flows eased off as Bitcoin and Ethereum reclaimed attention. That's normal. That's how institutional capital behaves. It doesn't sprint in one direction non-stop. It allocates based on risk, liquidity, macro news, and regulatory clarity. The fact that XRP is now par with Bitcoin in certain flows should be the only wake-up call you need. Bitcoin had a minor outflow yesterday. XRP held firm. That alone tells you smart money isn't walking away. So it's positioning quietly and absolutely intentionally. Then you have Nasdaq stepping in and filing to raise option limits on BlackRock CK's IBIT Bitcoin ETF to 1 million contracts. The maximum allowed. People read that and shrug like it's a random headline. It's not. It's a sign that derivatives volume, institutional leverage, and liquidity expansion are about to push into another gear. And yes, before someone tries to sound clever, options can absolutely create manipulation, and both upward and downward. But manipulation works in your favor when you know how to read the direction of pressure. More options means bigger players positioning for bigger moves. If Bitcoin is opening the door to larger leveraged exposure through ETF infrastructure, you better believe liquidity will spill over into the rest of the crypto market, especially assets with real utility narratives like XRP. And just look at dominance. Bitcoin dominance has been on a downtrend since early November. And what happened during that downtrend? Altcoins woke up, XRP included. But over the last 12-16 hours, dominance started curling upward again. That tells you one thing. Big players are reaccumulating Bitcoin for the next leg. People seem to forget that every single alt season in history has followed the same staircase pattern. Bitcoin rallies, consolidates, dominance rises. Then once Bitcoin stabilizes, capital rotates into altcoins with far more aggression. If dominance is shifting upward now, it means the Bitcoin reloading phase is happening, not the altcoin collapse phase. That's why XRP's sideways price shouldn't scare you. Sideways during a dominance rise is actually a bullish setup. It means XRP isn't bleeding while the market repositions, which often leads to an explosive catch-up once dominance cools. Now, let's talk sentiment because sentiment tells you more than charts. the Fear and Greed Index, finally pushed back above 20. Most people will ignore that because they don't understand what low sentiment actually signals. Extreme fear gives whales a discount. Low interest from retail means accumulation happens without competition. The minute the index starts drifting upward from extreme fear, historically you're in the accumulation phase before major upside. And that's exactly where we are. Not euphoric, not greedy, not overheated, just early in the sentiment cycle, the part where serious positioning is done. This is where I'm blunt. If you disconnect now, if you stop paying attention because nothing exciting is happening, you'll miss the exact window institutions love to exploit. Look around at Caspa, moved 50% in 2 days. Other midcaps did the same. There are always plays on the table. The difference between winners and bystanders is simple. Winners stay plugged in even during the boring parts. They track flows. They track dominance. They track ETF movement. They track how Bitcoin behaves around its EMAs. Bystanders walk away when the candles turn quiet, and then they return 3 weeks later asking, "What did I miss?" Everything. That's what XRP's setup right now isn't about hype. It's about structural positioning that most people overlook because it isn't loud. You're seeing ETF flows normalize, not vanish. You're seeing Bitcoin prepare for an expansion move with option limit increases. You're seeing dominance shift in a way that historically precedes massive altcoin rotation. And you're seeing sentiment crawl upward from extreme lows, the exact psychological zone smart investors thrive in and emotional investors ignore. This isn't noise. This is the foundation. And if you understand what this foundation means, you already know what comes next. Now, let's get into the part that most XRP holders underestimate, the macro setup, because whether you like it or not, every bull run in history has been triggered by macro forces first. Not utility, not hype, not even adoption. Macro moves the money, and right now, the macro indicators are flashing signals that most people simply aren't paying attention to. We're watching Bitcoin flirt with levels it hasn't interacted with in months, pushing above $91,000, and approaching the 100-week EMA, which sits right near $95,000. If Bitcoin holds above that level for several weeks, not days, it sends one of the strongest continuation signals you can get. Historically, once Bitcoin stabilizes above the 100-week EMA during a cycle, the rest of the market enters a fresh bullish expansion. But here's the part that retail always understands too late. Bitcoin stabilizes first, altcoins run second, and XRP typically moves in explosive waves, not slow climbs. Now combine that with what's happening in global risk assets. The housing market, specifically the U.S. single-family home spread, is screaming recession signals. New homes are selling for less than existing homes. That has only occurred a few times in modern history. 2007-2009, right before the financial crisis. Japan's last decade in the 90s and the UK recession in the early 90s. Every time that pattern appeared, it meant one thing. Liquidity was dying. And what does dying liquidity force central banks to do? Print, inject, stimulate. Call it QE, call it easing, call it stabilizing markets, call it whatever makes politicians sleep better. But the outcome is the same every time. Liquidity floods the system and risk assets erupt. And crypto is the highest beta risk asset on the planet. This is why calling the housing market weakness bad for crypto is ignorant. You don't get bull runs during tightening, you get bull runs during easing, and easing is exactly where we're heading. Quantitative tightening suffocated the economy, slowed lending, crushed builders, and pushed developers into desperation. That's why new homes are being slashed beneath existing home prices. Sellers aren't panicking, developers are. They need liquidity, they need buyers, they need capital. And the only way they get relief is through lower interest rates and QE, meaning the Fed's hand is already forced. The question isn't if, it's when. And here's where things lock together. The Fed ending QT on December 1st, the market pricing in multiple rate cuts for next year, and the futures market shifting toward a dovish Fed chair. You don't need a PhD to connect the dots. Liquidity is coming back. The cost of borrowing will drop. Banks will lend again. risk appetite will rise. And when the faucet turns back on, crypto is the first place capital rushes to because it has the highest upside relative to the liquidity injected. Now, think about what that means for XRP specifically. XRP is one of the few assets that historically moves in delayed but violent bursts when liquidity hits the system. It doesn't grind upward like Bitcoin. It compresses, coils, consolidates, and then detonates when liquidity pressure mixes with institutional flows. And that's exactly the type of environment we're walking into now. Add the structural ETF inflows, the tightening circulating supply, and the macro tailwinds, and suddenly this boring consolidation XRP is doing doesn't look weak at all. It looks like preparation. This is why focusing on weekly sentiment or temporary sideways action is the biggest rookie mistake you can make right now. You should be watching the trigger points. Bitcoin holding above the 100-week EMA, QT ending, and QE expectations rising. Housing markets stress-forcing policy change. Institutional flows rotating back into crypto. XRP maintaining structure during dominant shifts. When these align, or when they are aligning, the breakout window opens fast. And once it opens, XRP does not give you 3 months to think about it. Historically, it gives you 3 days. The people who win are the ones who are paying attention during the boring parts, not the ones who show up after the candle's already exploded. The setup is forming, the macro is turning, the liquidity is coming. And if you understand how these cycles work, you already know what that means. Talk about something that most investors completely misunderstand. The housing market. People look at real estate weakness and instantly assume it means disaster for crypto. That's lazy thinking. The reality is much more nuanced. And if you understand how liquidity cycles work, you'll see why the current housing signals actually strengthen the bullish case for XRP and the broader crypto market. Right now, the U.S. housing market is flashing a rare and historically significant pattern. New single-family homes are selling for less than existing homes. This almost never happens. Developers dropping prices below existing home values is the equivalent of the canary falling off its perch. It's the earliest warning sign that liquidity is suffocating the system, and this exact pattern only showed up in a handful of moments. The 2007 to 2009 financial crisis, Japan's collapse in the 90s, and the UK's recession in the early 90s. Every time it appears, it tells you the same thing. The economy is out of breath and needs stimulus. Developers aren't cutting prices because demand evaporated. They're cutting because they're drowning in debt, and the cost of capital is crushing them. They took loans at higher rates. They can't move inventory fast enough, and liquidity in the system is evaporating thanks to the extended period of quantitative tightening. Existing homeowners don't care. They aren't under pressure to sell, but developers must sell or they die. That is what forces this rare price inversion. And here's where the average crypto investor completely misses the point. When the housing market gets this stressed, the Federal Reserve has no choice but to pivot. You cannot sustain a real estate market when developers can't service debt and buyers can't afford mortgages. Something breaks, and that something typically forces the Fed into rate cuts and liquidity injections. This is exactly the environment that precedes major crypto expansions. Because when liquidity dries up, crypto doesn't rally. That's why the last long stretch of QT kept things suppressed. But when liquidity comes back through QE, lower rates, easier lending, crypto behaves like a spring being released. It doesn't just rise, it explodes. And XRP, historically, is one of the most reactive assets during liquidity cycles. It doesn't need perfect macro conditions. It only needs easing, and easing is exactly where we're heading. Now, layer this macro pressure onto what's already happening structurally in crypto. Bitcoin holding above key EMAs, ETF inflows expanding, NASDAQ preparing for massive option volume, XRP's supply tightening week by week, fear and greed climbing out of the extreme zone, Bitcoin dominance curling up just as altcoins build strength. The timing is almost too perfect, and most people still haven't connected it. This is why you cannot afford to think short-term right now. If you get stuck staring at daily candles or obsessing over minor pullbacks, you will miss the meaning of what's unfolding. Markets don't pivot on feelings. They pivot on liquidity cycles, and the liquidity cycle we're entering mirrors the early stages of every major bull run we've ever had. The housing market weakness is not a bearish sign for crypto. It's the final nudge that forces policymakers into easing, the very thing that sends risk assets into parabolic phases. And if you understand these patterns, you know exactly why XRP looks like it's winding up, not winding down. When liquidity returns, everything changes, and we're closer to that moment than most people realize. So, let's bring this all together, because the last piece of this puzzle is what suddenly shook the entire crypto market and sent money flowing back into risk assets almost overnight. And honestly, this is the part most people still don't fully understand because they don't follow the political and macro side of crypto. But you need to, because this is where the real moves begin. Out of nowhere, the projections for the next Federal Reserve chair flipped, and Kevin Hassett suddenly became the strong favorite. And if you've done your homework, you already know why this matters. Hassett is openly dovish. He's pro-rate cuts. He's pro-liquidity expansion. And more importantly, he is aligned with the administration that wants fast economic momentum heading into the next cycle. A dovish Fed chair at this exact moment is like opening the floodgates after years of tightening, and the market reacted immediately. But that wasn't the only catalyst. We're also just days away from quantitative tightening officially ending on December 1st. That is not a small milestone. That is one of the most important turning points in any macro cycle. When QT ends, the government stops draining liquidity out of the system. And historically, once QT stops, QE follows shortly after. That means money printing resumes, liquidity floods in, borrowing becomes easier, markets get oxygen again. Combine a dovish Fed chair, the end of QT, and rising political pressure to stimulate the economy, and you get the exact environment where risk assets ignite. This is why you saw crypto get a jolt of energy yesterday. This is why Bitcoin jumped back above $90,000. This is why altcoins stabilized. And this is why XRP calmly held its levels even while the entire market was reacting. Because assets with real utility and growing institutional demand don't panic at moments like this. They position. Now let's talk about XRP specifically. XRP is not trading like a retail-driven coin anymore. The ETF flows, the institutional allocations, the growing list of regions approving RLUSD, the aggressive expansion in UAE, the regulatory clarity coming from the SEC. All of that points to one thing. XRP is slowly shifting from speculation to infrastructure, and that's exactly why macro catalysts matter more for XRP than ever before. Liquidity cycles don't just help coins pump, they help real utility networks accelerate adoption and usage. And XRP's entire role, cross-border settlement, liquidity sourcing, institutional rails, compliant stablecoin integration, thrives when liquidity increases globally. The timing could not be better. So, where does this leave you? Honestly, it leaves you with a choice. You can ignore the signals, pretend nothing is happening, and keep thinking short-term like everyone who misses every major crypto cycle. Or you can start connecting the dots. Because when liquidity returns, when institutions load up, when ETFs ramp, when macro pressure forces the Fed to ease, you don't get slow, gentle price movement. You get acceleration. You get emotional breakouts. You get people chasing green candles they should have accumulated months earlier. You don't need to predict the exact day. You don't need to time the perfect entry. You only need to understand the setup. And right now, the setup couldn't be clearer. XRP is stabilizing during macro turbulence. Institutions are quietly positioning. And the liquidity cycle is flipping. This is the window before the window closes. Just remember, none of this is financial advice. It's educational analysis to help you think with clarity instead of emotion. Always do your own research, make informed decisions, and understand your personal risk tolerance before investing in